Charlie ran the Munger Partnership, which was like a hedge fund at the time. And in 1972, 94% of the fund was in two stocks. 61% of the fund was in blue chip, and 23% was in something known as the New America Fund. So let me just describe the New America Fund for a second, because you understand what's in blue chip. Because in 72, blue chip was basically had a market cap of well under 100 million, but had all these assets, with the float and such. The New America Fund was a closed-end fund. It was actually originally called the Fund of Letters. So a bunch of kind of flamboyant businessmen, with the help of some brokers, raised about $60 million. The brokers took about 10% of that to raise the money. So off the bat, the investors lost 10%. So there was 54 million left in the fund. And then they started to invest it. And they didn't do a very good job of investing it. So what began as $10 a unit, and then because the quality of investments was so bad, that fund started trading at a significant discount to underlying intrinsic value. So you could, like if you look at, I don't know if you've discussed closed-end funds. So if you open Barron's or even just go Google closed-end funds, you'll see there are thousands of these funds where, unlike typical mutual funds or ETFs, they've raised a fixed amount of money, and after that they trade like stocks. And sometimes you get a variance between the assets in the fund and the trading price. It can either sometimes trade at a premium, and sometimes it can trade at a discount, and sometimes the discounts can get pretty wide. So one can actually build a nice little career out of, in effect, buying closed-end funds and waiting for them to kind of get back on track. But so the fund of letters had dropped quite a bit in value, and well below the underlying assets. So Charlie Munger and Rick Gorin bought enough of the units to get on the board and then take control of the fund. So again, they got control of 60 million or 50 million in assets with just a few $1 million invested. And once they got control of the fund, they again liquidated the investments and started redeploying the money more intelligently. And so in 72, and they renamed it the New America Fund. 72, the New America Fund had a net asset value of $9.18. And by the end of 74, it had a value of $9.28, actually went up. But the price it was trading at was $3.75. It dropped a lot, because 72, 74 was when we had the Nixon impeachment and all these price controls. We had a lot of the oil embargoes and such. There was a lot of ugliness going on at that time in the US economy. And the stock market had crashed. And so blue chip stamps, which had a market cap of not of 80 million in 72, by the end of 74 was trading at a market cap of 27 million. So if you just think about blue chip stamps at the end of 74, it already owned See's Candy, which they had bought for 25 million, and it also owned Wesco Financial that they had bought for also 25 million, both seriously undervalued. Even then, the market was not willing to recognize that these were great assets. So the Munger Partnership reported over a 2-year period about a 53% drop in returns. It was a huge drop, and a lot of pain. In fact, Charlie Munger recalls that time as a very painful time. So what he did is, in 1975, I think 1975 the fund was up about 75%. But if you're down 50% and then up 75%, you're still not back up to zero. If you're down 50%, you need to be up 100% and such. So what he did was he liquidated the partnership. But what he also did when he liquidated was he distributed blue chip stamps and New America Fund to all the investors. So instead of giving them cash, he gave them these stocks and he just gave them instructions that, listen, just hold on to these stocks. And eventually, the New America Fund was eventually liquidated in 1986 for $100 per unit. So what was trading at less than $4 a unit went up 25 times. One of the companies they bought inside New America was the Daily Journal. So they bought the Daily Journal for $2 million inside the New America Fund. And then in '86, when they liquidated New America Fund, the Daily Journal started trading on the over-the-counter, now trades on the New York Stock Exchange. And that $2 million in the Daily Journal is today worth almost $300 million. So that's also done quite well. But you know, the thing is, while these assets did well, we had a period of serious pain where you had huge declines. And if you think about it, his investments were the most sensible investments he could make, because he had 94% of his investments in two companies in which he had control, knew the businesses really well, and they were trading at a huge discount. Even then, you had a lot of pain. And so that's the other facet that one has to keep in mind, is that none of these things come that easily.